Yeah, my name is Bernhard Schwetzler, and this is a short tutorial into one of the most important questions in corporate valuation, that is the terminal value calculation. So we have three sections. The first one is dealing with an important standard model in corporate valuation, that is the so-called Gordon-Shapiro model, and this is the introductory part where I will try to explain this model to you. So, to start with, why are we required to calculate terminal values? The reason is that unless explicitly otherwise fixed, the lifetime of firms is supposed to be infinite. No sane person makes projections over an infinite time frame, and so science and practice as well recommends to split the future into two parts. The first part is the so-called phase number one, where we make explicit projections, profit and loss statements, and so on. And phase number two is then assuming that the cash flows end of phase one are then continued to develop into an infinite time frame, and the terminal value is then the present value of this standardized free cash flows in this phase number two. The problem is that this depending on the length of this phase number one, the terminal value is very important for the total corporate value. Here in this slide, it is supposed to contribute to 85%, but in growth industries, you may even come to situations due to negative cash flows in the phase number one that the terminal value accounts for more than 100% of the total corporate value. So it's important, yeah? That's the first important message. So you see here in the next slide that we actually talk about some standardized calculations, that we assume a certain fixed pattern that the free cash flow is about to develop until infinity. So the first assumption would be that we look at the perpetuity, that is, that our free cash flows out of our firm are supposed to stay constant until infinity. And of course, as we know, the present value of a perpetuity is simply achieved by dividing this constant free cash flow by the cost of capital. In our case, this is the WACC. You see that we are working with the entity approach of corporate valuation. That is, we look at the free cash flow that goes into the pockets of debt holders and equity holders jointly, and the discount rate, the appropriate discount rate, is of course the weighted average cost of capital as being the average over the cost of debt and the cost of equity. So the first case is the perpetuity model, where we assume that the free cash flow stays flat and constant until infinity. The next step is the growth model, that is simply adding a constant growth rate to the entire problem. That is, we have a starting free cash flow in the first year of this phase number two, and the assumption is that this cash flow is about to grow with a constant rate G over an infinite time frame, and then we know the present value of a growing perpetuity is simply derived by taking the first free cash flow and dividing it by the difference between the WACC, the discount rate, and our growth rate. And here is the problem with terminal values, because, of course, the choice of the appropriate growth rate has a tremendous impact on the terminal value and, of course, by the same token, to the total corporate value. Yeah? So here's a simple example. If we have a free cash flow of 100 and we assume a growth rate of 0% and the WACC at 10%, then without growth, the value of this free cash flow, the present value, is 1,000. If we increase growth to 2%, then the value grows by 25% to 1,250. And if we increase the growth rate to 5%, then we get even double the value of 2,000. So the point is, the appropriate choice of G is very, very important for the terminal value and very, very important for the corporate value in general. And the problem coming from this is, of course, nobody can tell for certain what the growth rate of the free cash flows of a firm 5, 6, or 7 years from now to infinity will be. So we have all ingredients for a battlefield in the negotiations between buyer and seller of a firm, that is the appropriate choice of G. So here are some straightforward recommendations to sanity check the choice of G. You may double check by comparing your choice of G with the long-term GDP growth, for instance. Or if you have a firm that grows pretty fast over the first years of the phase number 2, then you may use fate factors that are decreasing the growth rate annually over the years, and then you come to a moderate level of growth then. Or another way would be that if you have a high growth firm currently entering this phase number 2, that you simply expand the phase number 1 over several years until the growth has cooled down to a moderate level. And finally, and that is what this brief introduction is about, I would like to show you a model that allows to derive the growth rate analytically by combining the retention rate and the rate of return on the operating assets in order to achieve a certain growth rate. And the model that combines these two factors is called the so-called Gordon-Shapiro model. Yeah? So this is what this introduction here is about. So the first step to approach to this Gordon-Shapiro model is to replace the free cash flow by an earnings figure. Yeah? You see here that we replace the free cash flow in the first year of our terminal value phase by the expression the NOPLAT, net operating profits less adjusted taxes, which is the EBIT times 1 minus the tax rate, times a factor that is 1 minus the retention rate. Yeah? So we simply reformulate the free cash flow as earnings figure times 1 minus retention rate. Note that the retention rate, of course, is the opposite, 1 minus the payout ratio. So this Q is simply to be interpreted as being the fraction of the earnings figure NOPLAT that is set aside in order to acquire new and additional assets. To get a better understanding of the meaning of Q, here is an additional slide that simply highlights again the derivation of the free cash flow out of our earnings figure. Yeah? So here you see that we start out with our NOPLAT, which is the earnings figure EBIT times 1 minus the tax rate. And then we approach here step by step by making our corrections, our free cash flows. Yeah? So you see that the first part of our adjustment is the difference between the depreciation and the capital expenditure. That is the net investment. Depreciation is to be added back. It's an expense, not a cash outflow, whereas CapEx is the opposite. So the difference between depreciation and CapEx is then the net investments. That is the investment that is made beyond the depreciation if this figure here is positive, that is, if CapEx is greater than the depreciation. And the second part of our wedge between earnings and free cash flows is the delta net working capital, which is to be interpreted as being the net investment of debt and equity holders into current assets. And finally, here we have our delta in the long-term reserves. That is simply the correction for another wedge between accounting figures and free cash flows. So you see that here, this is the absolute amount of retention. That is the difference between NOPLAT and free cash flow, and it can be interpreted as being either the positive or the negative net investment of debt and equity holders jointly in acquiring new assets. And one has to stress the word new here and additional, because the old assets under this assumption are simply replaced. So if we have a positive Q and a positive retention, absolute retention, then obviously debt and equity holders jointly sacrifice a part of their earnings in order to acquire additional assets on top of the currently of the assets that are currently in the firm. So you see that the retention rate Q may be interpreted as being the fraction of earnings that is set aside driving the additional growth in our asset base. And that's important to understand the background of the Gordon-Shapiro model, because now we come to an important idea that is simply the idea that obviously you cannot grow in earnings and in cash flows without growing in assets. And what we currently, or what we just have seen on the last slide, was that we have seen that the retention is the growth, is governing the growth in assets. And this slide here is about to show that the growth in assets, which is driven by Q, shall be in line with the growth in earnings, because if the two are not in line, the relationship between the two, which is then the rate on return on the invested capital, is obviously not not constant. Yeah. So in this example, you see here we have operating assets, invested capital of 100 million. We have operating earnings of 12 million, and our rate of return, the ROIC, the rate of return on invested capital, is linking the two. In our simple example, it's 12% here. Yeah? So, and now the idea is that the growth of both of assets and of earnings must be equal to each other. Otherwise, our ROIC is either hitting the roof or is declining towards zero. So we look at three cases here. I start on the right-hand side. Case number 3. If earnings grow faster than assets, so if this one here grows faster than this one, then obviously the relationship between the two is not stable. That means that if earnings grow faster than assets, our rate of return, our ROIC, would converge towards infinity, which is not a very good assumption. Remember that we assume that everything stays stable until infinity. And so that means that under this scenario, earnings grow faster than assets, we would have the observation that the ROIC would go to infinity, which is not reasonable, as we have the assumption that the WACC stays constant at the same time. The second case is the other way around. If assets grow faster than earnings, then obviously our ROIC would also not be constant. It would decline towards zero. And that's also not reasonable, because if the rate of return on our assets would somehow cross the threshold of our WACC, then obviously we would stop investing further into our business, because here in this area, obviously, we would destroy value and have negative net present value. So if this is not realistic, and if this is not realistic, the only thing that is left to be realistic is obviously an assumption, a reasonable assumption, that assets and earnings shall grow at the same rate, because if they do, this yields the result that our ROIC, our rate of return, stays constant. Yeah? And so with this reasonable assumption, I will try to show you now the link between retention, rate of return, and growth. Yeah? So here we have an example how to derive our Gordon-Shapiro model and our Gordon-Shapiro equation link using this assumption that assets and earnings shall grow at the same rate. The basic idea is that we may decompose the growth rate into Q, which is the assets, driving the assets growth, and the rate of return, which is then linking the assets growth with the earnings growth, and which we will see implies an additional backwards loop, that both assets and earnings grow at the same rate. So here is an example. Yeah? So we start out with operating assets of 100 and the rate of return that is supposed to be 12%. Yeah? So our first year's NOPLAT is 12, 100 times 12%. And now we assume a retention rate of 40%. That is, 40% of this NOPLAT is set aside in order to acquire additional assets, and 60%, which is 1 minus the 40%, is then paid out as a free cash flow to debt and equity holders, which in our case is 7.2. 12 times 60% is 7.2, and 12 times 40% retention rate is 4.8. Yeah? And these 4.8 are used in order to acquire additional assets, and that yields a growth in assets from 100 plus 4.8, which is 104.8. Yeah? So you see that our asset growth rate is 4.8, and that's exactly the 40% retention times the 12% rate of return. That is our asset growth of 4.8%. And as we said, we imply a constant ROIC. Obviously, this growth in assets is then transferred one-to-one into a growth in NOPLAT. Here, 104.8%, earning 12%, yields a NOPLAT of 12.58. And now, if we compare our NOPLAT of 12.58 with a NOPLAT in the first period of 12, then you can easily verify that the growth rate of our NOPLAT is alike the growth rate of our operating assets, also 4.8%. And then again, we set aside 40% of this 12.58 to buy new assets, which is 5.03, and we pay out 60%, which is 7.54, and that again yields another 4.8% growth of our assets. And you see that the link here is that Q times ROIC is governing both, is governing the growth of our operating assets, and by the same token is governing the growth of our earnings, and of course at the constant retention and the constant payout rate is finally here, of course, also governing our growth of our free cash flow. So finally, the final step is then that we simply use this relation here that says that growth is retention times return. Yeah? And as I said, retention drives the asset growth, and here our ROIC figure is then simply the rate of return of our additionally acquired assets that is then transferring our asset growth into earnings growth again. So finally, taking this relationship here and plugging it into our equation, we can do this in two ways. Yeah? So first, taking our equation from above here, remember the NOPLAT equation here, we can now plug in this relation in two ways. The first one is we simply replace the growth rate by the combination of Q and ROIC, or we simply solve this triangle here for the retention rate and then plug the ratio of growth over ROIC into this equation. So this is the version number one. Here we replace our growth by the combination of retention times ROIC, or the other way around here, we replace our Q here by the ratio of G over ROIC. Remember, still we look at the same equation. It still is free cash flow over WACC minus G. The first step was we replaced free cash flow by NOPLAT times 1 minus the retention rate. And the second step is we replace here the retention rate by the ratio of G over ROIC to end up with our Gordon-Shapiro model. That was the first step. Thank you for your attention.